we have gathered here today to decode Union Budget 26. It is privileged to have Laxmikant Lokhande with us as part of our panel. Lakshmi heads our fixed income desk and brings rich experience of having worked with reputed rating agency like ICRA, where he has observed things from a different lens. In his last role, he was heading the corporate treasury book with Go Digit Insurance. Uh, we would like to run through some numbers which came as projections in the recently concluded budget. So, if I could request Lakshmi to share his screen, we would like to get started. Thanks, Lakshmi. Your screen is visible to me. Without further ado, let me start by asking uh, the nominal GDP number at 10%, which is at the top, is a fair increase from the 8% number for this financial year. So, would just like to get your thoughts around this number. What will be the composition of the same?
Yeah, sure, Tanuj. So basically, if we see the nominal GDP growth, as we can see here for FY'27, the FY'27 budget estimates, the nominal GDP growth is assumed at 10%. And the nominal GDP growth assumes, say, important significance for the overall budget, because a lot of matrices for the union budget are calculated based on the nominal GDP. Now, in the previous financial year, or rather current financial year FY'26, the nominal GDP growth is assumed at in the revised estimate is assumed at 8%, and most likely it will be around that figure, as represented by most of the economists on the street as well. So this 10% figure on a low base looks, say, a reasonable estimate from a nominal GDP growth perspective. Also, if we see, say, nominal GDP in terms of dollars, rupee, we have seen after sharp reversal in the rupee after this US-India trade deal announcement. So at around 90 mark against USD, this translates to around 4.37 trillion in USD terms. Now, we keep talking about this 5 trillion and 10 trillion landmark from India's economic perspective. So it is also important for us to know where in dollar terms, the nominal GDP is projected for FY'27. So yeah, to answer your question, the 10% number looks a reasonable number, and it's a fairly conservative estimate from a growth perspective.
Thanks for answering that, Lakshmi.
Terrific. Thanks, Lakshmi. I see a lot of numbers on your screen. Let's get down to brass tacks. For the government, the primary source of revenue is taxes. What does that breakup look like? And with the recent GST rationalization, how will that affect tax collections for the government and general overall receipts?
Yeah, so Weber correctly pointed out, obviously the tax revenues is the main revenue source for the central government. Now, if we look at the say overall gross tax revenue, which is assumed at 44 lakh crore on a say YOY basis against say FY'26 revised estimate, that's a 8% growth. Now, this 8% growth is also say on a conservative side. There is an important metric which we need to see is the tax buoyancy. So tax buoyancy is nothing but it's a measure of how your taxes are growing in proportion to the nominal GDP growth. So we kind of take this growth of 8%, which is the gross tax revenue growth, and divided by the nominal GDP growth of 10%. The ratio which we arrive at it is 0.8. So the tax buoyancy is 0.8. So ideally, in a say steady state scenario, the tax buoyancy should be at least one. That's what government would want, that your tax revenue should be growing by the rate of the growth in the economy. Now we can see some figures in the past. They have kind of hovered from say almost 1.8 times to for FY'27 at 0.8 times. In FY'26, it was budgeted at 1.6 times. Now, in the revised estimate, we see a sharp fall, and this sharp fall is primarily because of the lower tax collection. So if we just come back to say an estimate of FY26 budgeted estimate versus revised estimate, we can see almost a 2 lakh crore kind of shortfall in the gross tax revenues, and that is largely because of the GST tax collection. So again, say 11.8 lakh crore of budgeted estimate in GST, we only are expected to achieve 10.5 lakh crore in FY26 revised estimate, and that is largely because of the what you spoke about, the GST rate rationalization which government undertook, the announcement which was done in the month of August, and the effective date was end of September. So obviously there have been some reduction in the GST tax revenues, and obviously the GST compensation cess has also been kind of stopped now. So that has also that has been lower compared to say budgeted estimates. And if we see that figure is blank in that cell is blank in the FY27 column. So obviously going forward there will be no GST compensation cess. So we are seeing a absolute drop in the overall GST collection, and that is largely because of this, GST compensation being no more applicable. So overall, if we see 8% growth on gross tax revenue number, we believe that it is a conservative estimate, and government should be able to kind of achieve it.
No,
So
thank you for
Lakshmi,
pointing.
yeah.
Go ahead, Danuj.
No, so Lakshmi, just a follow-up question since we are on this metrics. Even the income tax minimum slab was revised. So are you seeing any effect of the same in the direct tax collection in this year or the years to come?
No, so again, in the direct tax collection, if we see the corporate tax revenue growth is assumed at 11%, and the personal tax growth is assumed at 11.7%. So these numbers again looks reasonable. In the past, we have seen that these numbers have grown much higher in terms of their growth numbers in double digits or so. So again, overall, if we see the overall composition of gross tax revenue, the bulk of the revenues are being contributed on the say direct taxes side, because indirect taxes growth, as we can see here, CGST is only 6.3% growth. So these numbers again, overall gross tax revenue, and within that the breakup of direct and indirect tax figures, they both look achievable.
Sure. Thank you. So Lakshmi,
Lakshmi,
if
thank.
we, yeah, Vaibhav, go ahead. Sorry.
I just wanted to, since we've discussed taxes, taxes are a big part of the government's receipts.
Yeah,
Where is the rest of the money coming from?
yeah,
We'd love to know more about that because there's dividends, there's a lot of
yes.
other sources. We'd love to know more.
Yes, yes. No, so in fact, there are other two main components, which is say non-tax revenue and non-debt capital receipts, and those are sizable numbers, by the way. So non-tax revenue for FY27, for example, is 6.7 lakh crore. Now, this is largely in the form of dividend and profits. Now, within dividend and profits, we have two components. One is the dividend from RBI and the banks, and second is the dividends from the PSU companies. So this total number, by the way, is close to 3.9 lakh crore for FY27. Within that, obviously, the RBI dividend is the bulk of the component. So out of this 3.2 lakh crore, roughly 2.7 to 2.9 lakh crore is estimated to be coming from RBI dividend. Now, last year, we know obviously, there was sharp rupee depreciation, and RBI was kind of intervening in the market through its forex intervention measures. So in forex intervention measures, RBI kind of sells dollar and prevent the rupee depreciation. And as a fallout of that, there was lot of liquidity pressures in the economy, and which we all know about. That has led to less transmission from the when RBI did 125 basis rate cut since last 1 year. The inadequate liquidity was one of the reasons why we could not achieve that full transmission. Right. So one positive part of that RBI dollar sales is that historically this dollars are valued at a lower rate. And obviously, when RBI is selling it at a higher rate of, say, right from 85 to right up to 92, RBI has booked some profits. So that's just one part of the revenue. RBI does have another various other sources of revenue as well. RBI invest into government bonds, and obviously they receive a coupon on that. That is another major source of revenue. So this number of, say, what I'm saying, 2.7 to 2.9 lakh crore, that kind of looks reasonable. Last year in FY26, that number was 2.7 lakh crore. So this number is not very far off from, say, FY26 figure. So this number again looks achievable. And in the context that, we are kind of seeing a subdued nominal GDP growth, and as a fallout of that, we are seeing lower tax revenues. These kind of revenues in the form of, say, dividend and dividend from RBI and dividend from PSUs provides cushion to the overall revenue side of the government.
Sure.
Apart
Uh,
from that, in the non-debt capital receipts, the major component is the disinvestment receipts. So disinvestment receipts is nothing but, when government sells its stake in the various PSUs at various points of time. The prominent being, a couple of years back, government did sell their stake in LIC to raise a sizable amount. So this number, 80,000 crore, corresponds to, government's stake dilution in the various PSUs.
sure. So, Lakshmi, time and again, we have seen a miss on the disinvestment target set by the government. Do you
Yeah.
think they'll get their mojo back this year? We have heard a lot of deals in the final stages. So, if you can share your two bits on that as well.
So yeah, of the last few years, we have seen that government has kind of not been able to meet their disinvestment receipt target. For this year also, as we can see, this 80,000 crore is a sizable number compared to the previous year's realized figures. So there could be say miss here in terms of 80,000 crore. But given the fact that this is a, say, relatively small figure in the overall revenue receipt, so that should not kind of, bother the market much in terms of the disinvestment receipt target. There are a couple of companies which are in advanced stages, this thing. But we need to kind of really see whether this number can be achieved or not. The past suggests that, it may kind of undershoot to by some extent. But given the fact that this is a small contribution, so not much of a, say, worry sign from that perspective.
Sure, sure. And Lakshmi, if we can move to the expenditure part, we
Yeah,
all understand government has been doing a lot of heavy lifting in the last couple of years in terms of capex spend.
yeah.
So, do you think they have kind of now pivoted in terms of reviving consumption? So they are keeping their goal aligned as far as 10% step up on capex is concerned year on year. What has been your reading on that?
Yeah. So in fact, if we see, the overall expenditure has gone up from, say, 49.7 lakh crore in FY26 revised estimate to almost 53.5 lakh crore. That's close to, say, 7.7% jump in the on a YY basis compared to the revised estimates. Now, within that, if you see, the revenue expenditure is only growing by 6.6%, and the capital expenditure is growing by 11.5%. Right. So, as we can clearly see, whenever government spends more in capex, that's called the better quality of spending by government, because obviously the capital asset creation has their long-term benefits. So it is always considered as a good way of expenditure. So as you rightly pointed out, government has been increasing their capex budget, and this we have seen in the FY27 as well, wherein despite the, say, pressure on the revenues and the overall expenditure, they have kind of, allotted relatively more to the capex side. Also, we need to see there are two components here. One is the capex, which is directly done by, say, government, and there is something called as effective capex. Now, effective capex is nothing but when you add, say, grants in aid for creation of capital asset. This is one line item which we can see here. That figure again is a sizable number of close to, say, 5 lakh crore. Now, this is the amount of grants which central government gives to state governments and various local bodies and institutions for the creation of capital asset. So that is effectively again going into the creation of capital assets. So that figure is jumping up to in excess of 17 lakh crore. And if you see the growth over there is 22%. Now this may be looking like slightly ambitious, but even if there is some bit of shortfall over there, we are still talking about good numbers on the capex side. And just
Sure.
one thing I want to highlight is that the interest expense, it kind of constitutes almost 25% of the overall expenditure, and as a percentage of receipts also it is like close to 40%. So as we can see here, the interest payment budgeted for FY'27 is close to 14 lakh crore. So that's where, and it is obviously resulting from the gross borrowing number, which has been increasing over the years, which obviously we'll just talk about in our subsequent discussion.
Sure.
Thank you for that, Lakshmi. Since you mentioned where the money is coming from and where the money is going, now what is the differential between the two? What's our deficit looking like, and
Yeah.
how does the government plan to fund that deficit? And of
Yeah.
course, a lot of that may come in from borrowing.
Yeah, yeah. So, as you rightly pointed out, obviously this large expenditure and obviously revenue are not catching up to that extent. So the difference we call is fiscal deficit. In absolute terms, the fiscal deficit number is 17 lakh crore for FY'27. We can see the trend here. But here the number needs to be seen in the context of nominal GDP. Absolute number is not, say, an apple to apple comparison. So the target for FY'27 has been 4.3 against 4.4% of GDP in FY'26 revised estimates. But if we just see it at decimal points, this is not 10 basis, which is generally put out in the budget numbers. This is actually only 5 basis. So this is what people need to see, and which I pointed out in the initial remarks, that government has been able to bring down their fiscal deficit from almost above 9% to around 4.3% for FY'27 budgeted. But the path from here on will be only gradual because of the constraints on the revenue and the need for expenditure to be done on a year-on-year basis.
It's
Thanks,
heartening
Lakshmi.
to see that government is on the path of fiscal
Yes.
consolidation, and the deficits set to decrease, at least on a budgeted basis.
Yeah. And
Sorry,
these
Tanuj, you were
numbers
saying.
and these numbers, are crucial from a, say, overall macro standpoint, because when we talk about global or sovereign rating, global rating agencies do give a lot of weightage to these numbers. The another number is obviously the debt to GDP ratio. So just another information over there is starting from, say, FY'27, government is also targeting a debt to GDP target. So this number was always there, but now they have officially kind of put that into the target as per FRBM Act, and the target by FY'31 is 50 plus minus 1%. So we did see only 0.5% kind of fall from FY'26 to FY'27. In FY'26, the number is estimated at 56.1, and the budgeted figure for FY'27 is 55.6. So this number needs to be in the range of 49 to 51 by FY'31. So in next 4 years, this has to be brought down by at least 1 percentage point each year. So that is going to be a slightly tedious task in the coming next 3 to 4 years.
Usually, we've seen this number to be in the range of 80%. I believe that also includes state governments borrowing, right?
Yes, yes. This number is purely for central government.
That's right.
So thanks a lot, Lakshmi, to give context to all these numbers. They were looking overwhelming, but I think now we can make sense, and I'm sure it would help investors to navigate their fixed income portfolios better. I would like to conclude this session. Thanks everyone for joining.
Thank you so much.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.